CAIA Level 2, Topic 3, Institutional Asset Owners and Investment Policies. The very first chapter of Topic 3 is Chapter 11, Types of Asset Owners and the Investment Policy Statement. Okay, guys, we have now covered Topic 1, which was everybody's favorite, ethics, regulation, and ESG. Mind-numbingly interesting is the general comment we're getting back. Well, I hear that all, but I'm just going to have to caution us all just to remember the importance of it as well. I'll talk about that in a second. We've also covered Topic 2, which is models, also a very important one. Quite formula driven, not such an easy topic. That Topic 2, which is your models. Okay, and now we move on to Topic 3, which is institutional asset owners and the IPS investment policy statement. A relatively more gentle topic than what we've seen thus far, particularly in comparison to topic number 2. Okay, but just before we start Topic 3, let's just do a quick revision of where we are at. Okay, and how everything fits into the big CAIA Level 2 picture. Okay, we start off over here, guys. Remember topic number 1. There's Topic 1. Okay, Topic 1 is your ethics, regulation, and ESG. Then we have Topic 2. And of course, now we are on to Topic 3. And just a quick reminder, okay, how the exam is going to be set. Okay, you've got constructed response questions and you've got your MCQ questions. Okay, in terms of topic number 1, okay, you're going to have a 10% of the paper is coming from ethics, and it's only going to be in the what we call the paper number 2, or the afternoon paper, which is the constructed response paper. Okay, no, 0 multiple choice coming from there. Topic number 2, okay, and topic number 3 are guaranteed, and they give you a weighting. It's anywhere between 8 and to 12%. You can see it obviously averages out at 10%. 8 to 12% in both of those sections, guaranteed in their multiple choice questions. And that's fine, and that makes it relatively easy to see what's going on. The challenge that we've got, okay, is if we look at the total constructed response paper, okay, I'm going to pop us all the way through here, guys, to topic number 9, which is current and integrated topics, and there'll be another 10% question over there, making up a total of 30%, which is your entire paper due. But of course that doesn't add up. 10 and 10 doesn't equal 30. So where's the remaining 10 coming from? And this is a little bit of the gamble that we've got to be playing with a little bit, is topic 2, 3, 4, all the way through till topic topic 8. Okay, there's going to be one more constructed response question. So anywhere in the remaining 7 topics from 2, 3, 4, 5, 6, 7, and 8, there'll be another 10% for constructed response. Okay, so just be mindful as we go through topics 2 through till 8. Okay, we know for sure out of those, there's going to be 8 or 12% on each topic, okay, for multiple choice questions. What we don't know is where the constructed response question is going to come from. So just remember, constructed response, and we're going to still do a lecture on this specifically, okay, deals with more answering of questions as opposed to to multiple choice questions. So we have to be able to answer questions in a more written type of a format. So just be mindful as we go through topic 2 through topic 8 that we are able also to answer questions in a answer type format. And just by way of promotion, free promotion for the CAIA Institute, okay, is there, and I've put them on for you guys. Okay, I have put them onto the pacer for you. But the CAIA questions that we just extract directly from the workbook, okay, is more in a constructed response answer question type of a format, which will give you some good practice. So that's what you're likely to expect in terms of a constructed response type question as opposed to multiple choice. So please, as you go through the various chapters, do have a look at the CAIA questions that I've posted onto the pacer, and that'll give you a very good indication of what we can expect in terms of constructed response, particularly for topic 2 through all the way to topic 8. Okay, having said that, guys, let us jump straight into the work at hand, which is obviously Chapter 11. And Chapter 11 really, for us, starts the whole process of institutional asset owners. Okay, we're predominantly going to be working with 4 types of asset owners. Okay, very briefly. Number 1 will be endowments and foundations. Number 2 will be pension funds. Number 3 will be SWFs or sovereign wealth funds, and number 4 will be family offices. Okay, but as we go through this particular chapter, chapter 11, just be mindful that I'm going to take it quite quickly, and the reason I'm going to take it quite quickly, okay, is number 1, there are almost no formulas coming out of this particular chapter, number 1. Number 2, which is the more important reason, is that it's a bit of an introductory type of a chapter, and then remember, on each of these 4 major asset owners, there is a separate chapter. So, for example, endowments and foundations is going to be chapter 12, 13 will be pension funds, 14 will be sovereign wealth funds, and 15 will be family offices. So we will be doing each and every one of the asset owners in much greater detail in their chosen chapter. Okay, and remember again, guys, of course, anything from topic 1, which is ethics, all the way through to topic 8. Okay, each topic has got, interestingly enough, 5 chapters attached to it, which of course we cover every week. Okay, topic 9, which is the final chapter on current and integrated topics, has got 8. When we say 8 chapters, they're not really chapters; they're quite small. Much smaller than the chapters that we do in the first 8 topics. Okay, and again, guys, just before we begin, just a word of advice more than anything. When you finish every chapter, please do come back right to the beginning of the chapter. Have a look at the particular learning objectives and make sure that you can say something, understand that learning objectives, are familiar with what's in there. For example, if we have a look over here, when you finished doing chapter 11, you should be able to come back and say, okay, understand the different purposes of endowments and that foundations serve. Do I know that? Yes, I do. I'm done. Number 2, identify 4 types of pension funds. There's government, defined benefit, defined contribution. Yeah, I know that. Done. Okay. Discuss the role of sovereign wealth funds in today's market. Don't really remember much or know much about that. Cross that, and then just have a quick read of that again before you move on. Because you want to, by the time you finish the chapter, you want to be able to say, well, I know all the learning objectives, I'm familiar with them, and I'm happy to move on from there. Okay. And that's, of course, guys, why I printed right in the beginning, just as a bit of a learning guide, and you can come back and have a look at that and just revise that when you are ready. Okay, and there's the 2 pages on that. We move on. We start off over here, guys, now right in the beginning. Okay. And that starts off and demonstrate knowledge of endowments and foundations. Okay, and again, guys, these first 4 learning objectives I'm going to be speeding through, of course, because we're going to see them in their respective chapters. Okay, but very briefly, a foundation is an institution that makes grants funded by gifts and investment assets. Endowments, long-term funds, they're owned by generally non-profit organizations involved in charitable activities. Okay, generally speaking, they develop differently over the time period, foundations and endowments. And one of the key important things to remember, because remember, guys, we are doing alternative investments, that's the key focus behind what we're looking at. And both endowments and foundations we would have to categorize as long time horizons. So we have to look at the time is long time horizons. If that were so, you must always, and of course you guys, you are experts at this coming out of CAIA level 1, but the 2 things that I always want you to remember, once you've got a long time horizon, number 1, okay, you can invest, okay, your risk tolerance So your risk tolerance is generally a little bit higher because remember, with time, things can come right. You don't have to have money available straight away. With time, things will correct back to as they were before, even if one does have a down movement in a portfolio. So number one is your risk tolerance levels. You can tolerate more risk. And number two is you can invest in more illiquid investments because you've got time. You don't have an immediate liquidity requirement, so you can invest in more illiquid type of investments. And having said both of that you can have a bit slightly increased risk, and you can invest in illiquid investments. Of course, what is that? That opens the door then, of course, for alternative investments, particularly things like private equity funds, real assets like real estate, and hedge funds as well. Okay. We move on a little bit over here, guys. Let's move to learning objective 11.2, which are pension funds. We look at the 4 different kinds of pension funds, and that's all I'm going to really just show you. National, private pension funds. We look at defined benefit and defined contribution benefit plans. We'll look at both of those. And again, this is covered in massive detail in their own specific chapter, which will be chapter 13 for pension funds. And then we've got individual managed funds. Of course, this is only for the brave that manage their own funds on an individual basis. Okay, but again, I'm not going to be spending too much time on here because this is not their place. Okay, turn. Top of page 4, we go to the middle of page 4. We talk a little bit about sovereign wealth funds. Okay, and a sovereign wealth fund, or an SWF, okay, is a fund owned and run by the government. Okay, generally there to assist the citizens of that particular country, preserving wealth for future generations, etc. Okay, there are a couple, and we'll see this again, of course, guys, in chapter 14, sovereign wealth funds. Quite a few massive sovereign wealth funds out there. And just hopefully to whet your appetite and just to give a bit of thought, okay, is a question to the North Americans, I suppose, the Canadians, our friends from the UK, is where are your sovereign wealth funds? Because if we look at the big sovereign wealth funds, okay, Norway, China, Singapore, okay, nothing notable coming out of the Americas, okay, UK, and just to we'll discuss it when we get there, but just interesting to ponder that thought as to why there are no big sovereign wealth funds coming out of those particular countries like the Americas, etc. No criticism, just a thought to consider as to assess that particular market and see why not. Why yes and why not for the ones and not for the others. Okay. And the last little one is family offices. Family offices, okay, are predominantly for very high net worth individuals or their families, and you get what's called a family office that runs almost the entire family's needs for them, from their tax needs to their investment needs, to the extent that it even offers concierge services as well. Okay, this is for the ultra wealthy. They say generally family offices are for those with 1 billion and above. Okay, that's dollars, of course. Okay. We move on a little bit over here, guys, and now we talk about, top of page 5, strategic asset allocation. Okay, and strategic asset allocation, when looking at a particular portfolio, refers to the long-term allocation of assets to a particular portfolio. Okay, so what we do is we look at the portfolio, we look at the needs and the requirements of that portfolio, and we're going to see as we go forward, guys, where do I get to know a little bit about the portfolio? Where do I get to find out about it? In other words, how do I know what this particular portfolio's needs, requirements, objectives, constraints are? We'll talk about that in a second, but that comes from what we call the IPS, the Investor Policy Statement. Once I've got that in place and I know what this investor needs, what his goals are, okay, what his objectives are, what his constraints are, well, then I can start to allocate assets to him, and that allocation process is called SAA, Strategic Asset Allocation. Strategic Asset Allocation is long-term asset allocation. Okay, when I talk about strategic, it would be we would be remiss not to mention tactical asset allocation, which we call TAA, and completely different concept, of course, but let's just discuss that as well. Now, tactical asset allocation, okay, works quite similarly. Well, it's a close cousin of strategic asset allocation, And what happens over here and the difference between the two? Okay, strategic asset allocation. Let's say, for example, my portfolio has got a weighting, a target weighting. And I'm going to give you, let's say, for example, it's got a target weighting for equities. Okay, anywhere between, let's just make, for example, 15% of the portfolio through to 25%. That is its strategic asset allocation. And as long as it's within that target range, okay, we're okay. Okay. Comes along tactical asset allocation. Let's say, well, just to carry on with this example, let's say, for example, I've currently set my actual allocation is 20%. So my target is anywhere between 15 to 25, and my actual allocation to equities is 20%. Comes along tactical and says, oh, there's something very exciting happening in the market. Short term, I think I want to take advantage of it. Tesla's doing something very exciting, for example, a short-term opportunity. So we can sell a little bit of this equity that I've got over here, because remember, I can go down to 15%, so I can sell 5%, invest that in my short-term opportunity, which is called tactical asset allocation, to try and make a short-term gain on that. 2 points to mention about tactical. Point number one, okay, we take advantage of short-term opportunities, and number two, the opportunities are small. So for example, I would never take my entire 20% strategic allocation as it stands over there, sell it all, and then go and invest in a short-term opportunity. We take 2%, we take 3%, 4%, small amounts, and try and take advantage of opportunities within the market. Okay. When I look at the returns that come from asset classes, number one, of course, it's the short-term real risk-free rate. Okay, remember, it's short-term and it's real. Okay, this rate, of course, is generally very low. Okay, stable rate, but a very low rate, of course. And of course, you need to be earning at least that on your asset classes to make your investments. Plus, we take into account expected inflation. Of course, it's expected because I don't yet know what it is. Okay. And that's what we believe to be the long-term growth rate of the economy. And of course, a risk premium. And the risk premium will be dependent on the risk of the assets. The higher the risk of the asset, the higher the risk premium. And the lower the risk of the asset, the lower the risk premium. And these three, when added together, will give you your asset class return. Okay, nice little, if you wanted to classify that as a formula, you would be well within your rights, and you can say, well, there is at least one formula coming out of chapter 11. Okay, good. We move down, and we talk about this concept of calculating expected return. Okay, and it's a lot more difficult for alternative investments than for traditional investments. Now, why is that? Why is it difficult to try and calculate expected return for alternatives? Number one is we don't have that much information, historical data. Okay. Another point is that as we enter into the alternative space in an attempt to try and seek alpha and get extra returns, okay, as we do that and as competition increases, okay, alpha will tend to go down. And the reason that is because of the increased competition. Everyone's seeking the same alpha. Okay, good. And of course, the last point, as the economy changes, alternative investments change as well, making it a little bit difficult to estimate. Okay. Top of page 6, we talk about caps and floors on asset allocation. So again, for example, caps and floors, let's say, for example, I'm looking at my equity allocation. I would say to you, okay, my cap, the maximum I'm prepared to go to is 25%. Okay. And the floor on that particular investment, let's say, for example, is 10%. So I've set myself caps and floors on a particular asset allocation. Okay. The question is, why do we do that? Number one, okay, is when allocating to certain assets, okay, and I'm making too small an allocation. Let's say, for example, I'm only allocating, say, 1% through to equity. Okay, it doesn't make any sense for me to go and set up a dedicated team to earn for a 1% allocation. Okay. On the reverse side, if I make my allocation 90%, which is too high, okay, there may not be enough investment opportunities. So what do? I set a floor on the downside and a cap on the upside. Point number two, if the allocation to specific assets is too small, I'm going back down to the 1%, it's not going to have much of an impact on my portfolio. So I set a floor. at least 10%. On the other side, if I set myself 90%, okay, investment, that's too high, and I might be inadequately diversified by investing in too concentrated a portfolio. Okay, and point number 3 is, of course, when I'm looking at my caps and my floors, these highs and lows that I set myself caps and floors for, just be mindful of the fact that I need to take into account the liquidity of the portfolio. Okay. We move down, and now we're going to learning objective 11.6, which is the real RPS stuff. Okay, and we talk about RPS, of course, being the investor policy statement. Just as by way of introduction, when we look at this thing called an RPS, okay, investor policy statement, it's typically broken down into 7 sections, 2 big sections, and then 7 little ones. The first section we talk about what are the investors' objectives, of which there are 2. There will be return objectives and there'll be risk objectives. Of course, these 2 are quite closely linked. Okay. Then we talk about constraints. What are the constraints that are placed upon the particular investor? And the way CAIA looks at constraints, as opposed to, for example, the CFA looks at constraints, CAIA breaks them down into 2 major sections. Okay. Internal constraints and external constraints. Internal constraints are constraints that are placed upon the investor internally, like things like time horizon. Okay. External constraints are constraints placed upon the investor, things like that are external to him, things like taxes. Let's go through all of these now as we go. Okay. We start off over here, guys, and we talk about return objectives. We break this down into 2 major concepts. There are desired return. Yes, that's what the investor would like to earn in order to meet all of his goals. And some of the goals may be a little bit more optimistic. A second holiday, a second home, an overseas holiday, things like that. And then there's the required return. And the required return talks about the return that has to be earned in order to maintain a certain lifestyle, to pay school fees, okay, to repay the bond or the mortgage repayments, things like that. Okay, that's return. We then move on to the second objective, which is risk, and we break risk down into 2: ability to bear risk and willingness. Now, let's first talk about ability. Now, ability is, are you able to bear risk? In other words, we look, in order to determine if you are able to bear risk, we look specifically at your financial circumstances. Over the page, okay, we talk about, okay, what will give us an indication, okay, that the investor is increasingly able to bear risk. And look at the word specifically, will increase his ability to bear risk. The longer the time horizon, remember, the longer the time, the more you can bear risk. You've got more assets than you've got liabilities. Goals versus the size of the portfolio, we'll look at that. Have you got secure employment? That'll also increase your ability to bear risk. Have you got insurance against your losses? Okay, and certain goals that can't be put off till a later point in time. Okay, and we look at some of those, guys, and that'll obviously give you an indication of the investor's ability to bear risk. Willingness, and willingness to bear risk is a completely different concept, and that's dependent on the person. So a person might well be a billionaire, but he doesn't like to bear risk. He doesn't like risk. He's a risk-averse guy. Or you might get a guy who is not so well off, but he loves risk. He's risk-seeking. Okay. Generally, by asking your clients to fill out a short questionnaire, you'll be able to determine quite quickly what type of investor they are. Risk-averse or risk-seeking. Okay, we move on to learning objective 11.7. Now we're going to the constraints section. Remember, the RPS, just very briefly again, guys, is broken down into objectives and constraints. The objectives are risk and return. The constraints are internal and external. Internal constraints are liquidity, number 1, because that's placed upon the person. Have they got liquidity requirements? Okay, and remember again, what I want you to come out of this particular section with is to be able to look at the interactions between the various constraints. So let's say, for example, the guy's got a very highly need for liquidity. Probably, if that were so, his time horizon would be quite low. because he needs the liquidity, which would obviously preclude then investment in certain alternative assets. Okay, we move on. Well, at the top of page 8 are a few examples of what liquidity requirements are. Okay, we move to point number 2 over there, time horizon, and that's also quite closely linked to the type of investment and liquidity. The longer the time horizon, probably the lower the level of liquidity required. Okay, and then probably a greater investment in alts, things like private equity, hedge funds, etc. Okay. It's not written here in the notes, but just it's a lovely term which I just thought let's mention, just because we're not just here to get a designation. We are here for that as well, but we're here to gain knowledge. Okay, and one of the lovely point is what we talk about is, why is it that the longer the time that a person has, the greater the chance of coming right with investment? So if you incur loss in the first 6 months of an investment, but you're in that investment for 20 years, very likely that you'll make up those losses over time. Okay, and just the concept that I want to talk about, just to mention, it's an interesting one, and it's called time diversification. You don't need to know it, but it's just, I would like you to let's gain some knowledge. Time diversification. Okay, and that's obviously that as time goes on, you become diversified as a result of time. Okay, number 3, sector or country limits. This again is our last internal policy constraint, and that talks about that the investor, and you can see why it's an internal policy constraint, because the investor himself sets limits on investing in certain sectors, things like medical, banking, things like that. Of course, medical is the place to be now, as all of the various medical companies are coming up with their COVID-19 vaccines. Okay, countries, I'm not going to insult or praise any countries overly. We are not where one should or should not be. Other than just to tell you, certain institutional investors would have restrictions on certain countries, for example, emerging countries, things like that. Okay, good. We then talk about external policy constraints. These are external to the investor, things like taxes. Okay, you've got the different tax codes depending on where you are. Your marginal tax rate, that's your highest rate. Then you've got your average rate, and we just talk about capital gains being realized and unrealized, just different kinds of taxable capital gains. Okay, and your last little bit over here, guys, is legal and regulatory. Okay, again, external to the investor. What are some things in legal and regulatory? These would include things like, okay, the role that certain government institutions, financial institutions, financial bodies play within the investment area. Okay, fiduciaries, would you have the definition of being a fiduciary, which obviously holds you to a higher standard of care. Things like ERISA would come to mind as well. Okay, all of this would fit under the legal and regulatory section here. Okay, and guys, the very last learning objective, we talk specifically a little bit more about the IPS, and again, I'm not going to spend too much detail on this, because again, we will see all of these in their respective places. But we start off over here, guys, and we say, what are the benefits of a thoughtfully developed IPS? When I'm looking at an investor policy statement, what are some of the benefits if it's done correctly and properly? Okay, number 1 is the long-term objectives, investment objectives of the investor will be spelt out in this particular document. Okay, and that'll obviously help us to put procedures and policies into place that will help us meet these objectives. Okay, number 2, risk tolerance and investment beliefs, okay, will be provided for. Number 3, okay, the investment program will be monitored and measured against the investment objectives. Okay, number 4, new staff. Okay, anybody that comes on board, new staff, board and investment committee members, okay, will able very quickly, if there's a document that has got all the details of the investments, the objectives, the constraints detailed in it, they'll be able to come up to speed very quickly. Number 5, you can take a much greater strategic and holistic view regarding the investment program. Okay, and number 6, it's a bit of a serves as a roadmap for fiduciaries. Okay, how they need to behave in the various market cycles. What happens if the market is dropping? What happens if the market is in a bull market, etc. We go over our page over here, guys. The introduction, scope, and purpose of an RPS. Okay, the first section of an RPS, an investor policy statement, gives context for the program. Okay, it describes the asset owner and mission. Of course, guys, you won't learn this off by heart. Just get a sense of it. The purpose and scope of the RPS. What is the investment policy? I know everybody's favorite section coming out of topic 1, things like ESG, regulation, all that good stuff, and ongoing review. Of course, the RPS is an evolving document and doesn't stay the same because the market changes, the client changes, and obviously that needs to be taken into account within the RPS. Okay. We look at the roles and responsibilities within an RPS. Who are the people? We look at the following five categories of people. The board of directors is always, as we say all the time, with respect to corporate governance as well. They are the ultimate body that's responsible for the company, for approving investments, etc., etc. They are the buck stops with the board of directors. They're the highest governing body. Keep in mind, of course, they can also delegate some of their responsibility, but the ultimate responsibility will always reside with the board of directors. Okay, they may decide to delegate a little bit downwards towards the investment or finance committees, okay, to assist them in the investment recommendations. There's internal staff that work on a day-to-day basis within the investments. That could be an internal role or could also be an outsourced role. Okay, you've got your investment advisors, same story. These are the people that help you with your investments. And trustees and custodians are your final part of the puzzle. Okay, those are all your people involved in an RPS. Investment objectives. Well, we've spoken about investment objectives. I'm not going to speak much more about the objectives. Okay, other than to tell you we will see them all in the correct spot for the different institutions. Time horizons. Again, I'm not spending time on, nor on risk tolerance. We've spoken about those already, guys. Okay, and we will see those in much greater detail, of course, when we get to the particular sections, chapters 12 all the way through till 15. Okay, spending policies. In other words, how much can the particular is the asset owner, the institutional asset owner, required to spend? We're talking specifically here about foundations and endowments, and again we will see specific spending requirements for foundations and endowments coming out of chapter 12. Okay, we talk about asset allocation guidelines within an RPS, and again, okay, we spoke about that a little bit, that we give ranges or guidelines to the specific allocations. Remember previous pages, we spoke a little bit about caps and floors, ranges of asset allocations. That's what we're referring to here. We'll talk about those further as we go. Okay, we come to an interesting section over here, guys, selection and retention of investment managers. Now, when we talk about selection and retention, one of the things that they mention over here, guys, is when you're looking at your investment managers, don't look at them in too minuscule a manner. Don't use too much quantitative standards or watch lists and say, for example, okay, this quarter my manager was the worst performing in the quartile. Okay, maybe so. Okay, but that is too quantitatively focused or watch list focused, and not the best way to assess a manager, because he may have just had a bad quarter. But if you're using these particular approaches, you are very likely, okay, to terminate his services, and he might have had 15 good quarters and now he's had one bad quarter. Doesn't necessarily make him into a bad manager. The better approach to use, okay, is you to use long-term performance. How's he been performing on the long term? The consistency of his investment style, the stability of his investment team. You look at his bench. You look at him versus benchmarks versus his peers. Use other factors, in other words, to be able to assess your managers as opposed to short-term quantitatively based factors only. Other areas to include: suitability of the strategy and diversification. Okay, does he keep to investment guidelines? What are his level of assets under management? And what are his service levels and what are his fees? These are all things that must be taken into account when assessing a manager. Okay, top of page 12, strategic investment guidelines. Okay, there should be a strategic investment guideline contained in the RPS. okay, which is a very important framework to evaluate the different choices or different assets that we allocate to in order to try and achieve our investment objectives. In addition, this gives guidance to staff and fiduciaries while conducting due diligences and looking at the strategic and tactical asset allocations. Okay. We talk about performance measurement and evaluation within an RPS, also very important, guys. Okay. And remember, we always need to, as we do with any kind of performance measurement, we need to measure the particular person, okay, the particular manager, the particular investment professional against a benchmark. And of course, remember that one of the keys that we need to look at as well and focus upon is that that benchmark must be set up, okay, before we start. You can't set up a benchmark for a person or measure him up against a benchmark post fact and say, well, I think, well, you didn't perform nicely against this. He needs to know what he's competing up against and what he's going to be measured against in order to be fair to the manager. Okay, and lastly, we look at some additional considerations in an RPS. I know you guys have loved ethics and regulation, and of course, particularly ESG. Okay, but of course, it's important. We're not minimizing. It's just it's not the most stimulating study material, of course. We talk about responsible investing. Okay, that will be ESG, environment, climate, all of those things that we need to take into account. Okay, proxy voting. It's very important within your RPS to contain details of how you want your vote to be voted. Okay, because remember, proxy vote is a very valuable commodity. We talk a little bit about point number 3, guys, brokerage and other investment related expenses. Okay, you'd like a statement included in your RPS that talks about where to send your brokerage, who can, if you guys remember from the ethics section, particularly from CAIA level 1, there's a thing called soft dollars. What are soft dollars? Soft dollars are when a manager purchases investments, they pay a brokerage. Now, often that brokerage amount may be higher if they're buying research together with the brokerage as well. So they pay 1% if they're just going to trade stocks, but if they're trading stocks on behalf of a client as well as providing research, they may charge an extra half or an extra percent for that. And it's just very important to remember that that extra percent, okay, is being incurred on behalf of the client. So one has to make sure that it is, of course, to the benefit then of the client. And liquidity policy, it's also important. We've spoken about liquidity as we go through this. Just important just to remember, of course, that liquidity must be taken into account for within the RPS just to match up to the needs, the liquidity needs of the particular asset owner. Okay, that brings us to the end of chapter 11. It's a rather nice little chapter, and serves as a most wonderful introduction to chapters 12 through till 15, which of course are the more specifics behind it. As you can see, guys, over here, as per normal, you've got a few little checkers. Just make sure that you are able to do those. Nothing too difficult. Remember, they are called checkers. They're not necessarily yet exam standard. That is coming, of course, but let's just make sure we know the information first. There's your solutions behind those. Okay, and just make sure you are familiar with all of those. There is no past exam question based on here. Remember, I said to you in the past, I always try and go back in terms of the old CAIA level 2 syllabus to see if I can't find something that relates specifically to the new syllabus in terms of past questions that they asked that I could include in here for you to give you a bit of exam type practice. Nothing over here, of course, for chapter 11, and the reason for that is that chapter 11 is a completely rewritten and new chapter. It wasn't at all in the old CAIA level 2 syllabus. It's a brand new one. No questions available for that, of course, from the past stuff. Good news, though, is that for chapters 12 through till 15, those are all the old chapters contained in CAIA level 2, so I'm going to have plenty of past CAIA level 2 questions there for you to practice upon.